When stock prices drop, where's the money? Have you ever wondered what happened to your socks when you put them in the dryer and never saw them again? It's an unexplained mystery that may never be solved. Many people feel the same way when they suddenly find that their brokerage account balance has taken a nosedive. Where did that money go? Fortunately, money that is gained or lost on a stock doesn't just disappear. Read on to find out what happens to it. Key takeaways. When a stock tumbles and an investor loses money, the money doesn't get redistributed to someone else. Drops in account value reflect dwindling investor interest and a change in investor perception of the stock. Stock prices are determined by supply and demand driven by investor perception of value and viability. As long as you don't sell your shares, you have a chance to regain lost value. Disappearing money. To understand how money seems to disappear, it's important to know that supply and demand drive stock prices, regardless of whether the market is rising, a bull market, or falling, a bear market. It's the fluctuations in stock prices and the points at which you buy and sell shares that determine whether you make or lose money. Buy and sell trades. If you purchase a stock for $10 and sell it for $5, you will lose $5 per share. However, that money doesn't go to the person who buys the stock from you. For example, if you were thinking of buying a stock at $15 and before you do so, the stock price falls to $10 per share, you decide to purchase at $10. You didn't gain the $5 depreciation in the stock price, you simply got the stock at its current market value of $10 per share. The same is true if you're holding stock and its price drops, leading you to sell it for a loss. The person buying it at that lower price, the price you sold it for, doesn't necessarily profit from your loss. No one, including the company that issued the stock, pockets the money from your declining stock price. The changes in price are simply an independent byproduct of supply and demand and corresponding investor transactions. Short selling. Investors who engage in short selling profit by selling a stock at a perceived high price with the expectation that it will decline. If the stock price falls, the short seller profits by buying the stock at the lower price and closing out the trade. However, short sellers are not directly taking money from long investors who lose on a stock sale. Their transactions are independent. Implicit and explicit value. The most straightforward answer to where the money goes is that it disappears into thin air due to a decrease in demand for the stock. More precisely, this reflects the complex nature of money, embodying both implicit and explicit value. Implicit value. Implicit value is determined by personal perceptions and research of investors and analysts. For example, a pharmaceutical company with the rights to the patent for the cure for cancer may have a much higher implicit value than that of a corner store. Changes in implicit value, which are often driven by faith and emotion, cause changes in stock prices. A decrease in implicit value means the stock's price drops, leaving owners with a loss in value, even though no one else necessarily receives the money. Explicit value. Explicit value, or the accounting value, book value, is calculated by adding up all assets and subtracting liabilities. This represents the concrete value of a company. Without explicit value, the implicit value wouldn't exist. Investors' interpretation of the financial health and performance of a company is based on its explicit value. Explicit value drives implicit value. Disappearing trick revealed. When investor perception of a stock diminishes, so does the demand for the stock and the price drops. For instance, if Cisco Systems Incorporated had 5.81 billion shares outstanding, a $1 drop in share price would mean more than $5.81 billion in implicit value loss. This change occurs not in explicit value but in the perception of investors. The explicit drives the implicit. Investor faith and expectations translate into market value, but this is supported by the company's ability to create something useful. The better a company is at meeting demand, the higher its earnings, and the more confidence investors will have. Should I sell stock if it goes down? Unless there's something fundamentally wrong with the company's financials or you need the money, it may be worth waiting to see if the stock price recovers. Avoid panic selling. Do you lose money when stocks drop? When the market declines, the value of your stock investments can drop too. However, if you don't sell your shares, that value can recover when the market rebounds. Thus, while you may temporarily lose value, it can be regained. What are unrealized gains and losses? Unrealized gains are increases in the value of an asset you own, while unrealized losses are decreases in value. These gains and losses become realized when you sell the asset. Unrealized gains and losses can change as long as you own the asset. The bottom line: in a bull market, positive market perceptions drive wealth creation, whereas in a bear market, negative perceptions lead to wealth destruction. While the mystery of disappearing stocks may remain unsolved, changes in stock prices can be attributed to investor perception and the underlying value of companies.